So what are we going to talk about? Oh yeah. So today we are going to look at how you can legally save some tax when you're in the UK. Now, I've tried to pick up on a bunch of different tactics and things you can do that will be relevant for most of you. So some people are going to be self-employed, some people are going to work for someone else, some people are going to be business owners, some people are going to get closer to retirement age. So there's loads of different little things you can do. But the big caveat to start off with is I'm not an accountant, so I have put some numbers aside, some of these things of like, how much you can save and what percentage tax you could potentially save or what you'd be paying. Don't trust me. I'm pretty sure I'm right, but still, I'm not an accountant, so don't trust me. And make sure you run these things past an actual trained, qualified accountant. So once that caveat's out the way, first things first, there's a load of them, so I'm just going to try and quickly go through them all. So let's start off being quite nice. Giving to charity. Now, there's a couple of different ways you can do that, and I think I pick up on it in a couple of places as well. But if you just donate to charity, there's always that gift aid box you can tick, and that means the charity gets to claim, I think it's 25 pence for every pound that you donate to them, which is nice. But if you're a higher rate taxpayer, you can also claim the difference between the 25p that they claim and the tax that you pay. So, 15p or whatever it might be. So you can actually get some tax savings by donating and being a high rate taxpayer. The other way you can donate to charity, if you work for somebody else or if you're employed by yourself and in control of your own salary and stuff, you can actually give to charity it's called salary sacrifice, so pre-tax. So that means you're just not going to get taxed yourself before it comes out. Not that big of a difference between the two, but one's a little bit easier for you. So the pre-tax salary one is probably the easiest one, but it depends on the employer and whether or not they let you do that. It's the accounts and HR departments are probably the people you want to talk to if you work for someone else to check most of these things out. Now, the other thing you could do, which is I'm starting off trying to encompass everybody, and then I'm going to niche down a little bit into different groups of people. So the other thing you could do is challenge your council tax. Now, this can work well, or it can massively backfire. But basically, the council tax rating bands were all done, I think in 1990 was the valuation, and they put them in different valuation bands. Now, obviously, a lot of houses weren't built then, because it was, 31 years ago? Jesus, that's a long time. And so what they did was kind of work out roughly what it would have been worth back in 1990 using house price inflation figures, blah, 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 and put you into a council tax band. Now, you can challenge that if you think you're in too high a council tax band and potentially get it reduced. Downside is, if they review it and think that you should be in a higher rate band, they can also put it up. So only do that if you've done a bit of research and you actually know there's a good chance you can reduce your council tax bill this way. But it's a thing. Another one you could do, it's not technically a tax, but it kind of is in the UK, is your TV license with the BBC. Now, a lot of people I know don't have TVs or don't really watch normal TV, as it were, back in the day. So if you don't watch any live BBC, any live programs and no live or on-demand programs with the BBC, then you don't technically need a TV license. So double check on the website, make sure that you do qualify, but you can basically send them in an online form that says, I don't need a TV license for these reasons, bugger off, stop sending me letters. And okay, it's only 160 quid, 157 or something, I think, something like that. But still, better in your pocket than somebody else's, potentially. Other things, so seeing how we're getting into houses now, because your TV's in a house, that was my tenuous link, you could rent a room out. Now, there's a couple of other bits as well, but basically you can rent a room in your house and earn up to, I think it's £7,500 a year without paying any tax on it. So this is kind of house hacking, but if you've got a 2-bed house and you live alone, you could rent out that second room for £7,500 a year and you don't have to pay any tax on that, which is nice. But there is also, on top of that, something called, I don't actually know what it's called, so I probably shouldn't have said that, but I think it's called the digital tax, which gives you an extra £1,000 on top of that, so you can effectively charge £8,500 a year and get all of that tax-free. Now, the £1,000 extra on the digital tax side of things, You can get that for renting out your driveway or things like that. It's basically renting out your property or something to do with your property. Could you rent out your garden? I guess you could. Bit weird, wouldn't it? But whatever, you could if you wanted. The other part of the digital tax, though, is you can sell, I think it's £1,000 worth of stuff and things without paying any tax on it. So eBaying stuff, Gumtreeing, Facebook Marketplace, I think it's called. Anything like that, you can sell up to £1,000 and, again, not pay any tax on that profit, which is good. And then finally, the things that cover pretty much everyone, it's a complete lie, there's a bunch of them that still cover other people, so I'll just shut up. The other thing, the next one, is your personal savings allowance. Now, for the majority of you, it's going to be, you can earn £1,000 per year in interest before you have to pay tax on that. Now, if you earn less than £12,500 a year, you can actually earn £5,000 in interest before you pay tax on that. So effectively, you could have, £17,500 as an income if £12,500 of it was earnings and £5,000 of it was interest. If, however, you're a higher rate taxpayer, that's what I was talking about. So if you're a higher rate taxpayer, then that drops from £1,000 down to £500. So a little bit less fun, but still, it's £500 of interest that you don't have to pay any tax on, which is good. And so what you could do, if you're thinking about contingency funds and where to put that money, then you could put the cash into a savings account somewhere up to the point where you're earning 500, 1,000, potentially £5,000. You're not going to pay any tax on that. Once you get past that point, though, one other thing you could look at is premium bonds. Now, because they're qualified as a gambling game of chance, lottery, whatever you want to call it, then you don't pay tax on the winnings, the returns that you make. Now, the governments back premium bonds, so they're pretty safe and secure. I think the headline rate of interest at the moment is 1%, which is a bit rubbish, but for safe and secure money, it's not too bad if you compare it to savings accounts with banks and stuff like that. So that is an option. And the 1% obviously sounds a bit rubbish, but if you're a higher rate taxpayer and you're paying interest on 1% in a savings account, it can actually work out as not that bad. It's still not great, but it's not that bad. So you've got that. The next one is an ISA account. Now, a lot of people, when I say open an ISA account, automatically think of just a cash ISA. They are dog shit. So you probably want to avoid them. The amount of money you'd have to put into a normal savings account to go over your 500, 1,000, 5,000 personal savings allowance is so much that by the time you've got that much money, you should really be looking at one of the other ISAs. So my preference is always a stocks and shares ISA, but headline figures, it's 20,000 a year. And once you put the money in there, you get an allowance every tax year. So 20,000 this year, next tax year, etc. Once the money's in there, though, whatever you invest in, none of the income, none of the capital gains is taxable. Yeah, that's a word. So you can make as much money as you want and the government can't touch it, which is nice. So that's definitely something to have. And also on that, but it also covers a few other different points here, is using your partner's allowance. So if you've got two people, and I'll go into it from a salary point of view a bit later, but if there's two of you and you've got enough savings to put, say, £30,000 away each year, you could put 20,000 into your ISA and you could also put 10,000 into your spouse's ISA. Now, it does have to be a gift, so you can't put any caveats on it. There's like, well, if I decide I don't like your hair colour anymore, I want my money back. That's not how it works. So, be careful with that. But you can spread the allowances between two different people, which is good. And moving on to that, once you're over your ISA allowance and you've then got capital gains tax to think about. So if you just invest in the stock market outside of an ISA, if you make a profit, and I think it's about £12,500 profit you're allowed to make before you pay any tax, anything over and above that, you will pay capital gains tax. What you can do is at the end of each year, look to see how much profit you've made and actually sell at the end of the tax year. So let's just say the end of March, you can sell and crystallize that profit, and hopefully it's a lot more than the capital gains allowance, but if it's not, if it's that £12,500, you won't pay any tax on that profit. And then what you can do is, you used to be able to wait till the next day, so the 4th, 5th of April, the very next day, buy exactly what you've just sold and wait another year. They've stopped you being able to do that. You now need to leave 30 days between selling and buying the same thing again. Otherwise, it doesn't count for capital gains purposes. What you can do is something called bed and ISAing. So you could sell it personally, and then you can buy it within an ISA. Pretty sure that's still allowed. Or if that's not, which I bring it is, but you can bed and spouse it, where you sell all of your investments, crystallise £12,000 worth of profit, no tax to pay. Your spouse does exactly the same thing, and then you swap portfolios effectively. So you buy everything that they've just sold, they buy everything you've just sold on the same day, or sorry, the day after. Well, it can be the same day actually. And that way, you've still got exposure to the same asset classes, whatever it might be, and you've not paid tax on it. And you can do that every year so that you get your 12,000 each year. Because if you wait for, say, 10 years and you've got 120 grand worth of profit, you will be taxed on whatever the capital gains tax allowance is at that point, but it'll be 120,000 less, say 12,000. You'll be taxed on all of that gain, whereas you could have done it without paying any tax. And it also works if when you do that, you'd actually make a loss, because you can make that loss and then carry forward the loss for future years. So that's nice. Now, we talked about a little bit before, what did we do? We talked about salary sacrifice earlier. So you can get your company, if it's your company, or you can ask your employer, you can get them to pay for things before they pay you your salary. And it's called salary sacrifice because you're giving up part of your salary for a benefit. Now, most people have heard of this with childcare. If you can get your company to pay for the childcare, that comes out of your salary, whatever. The other big one is the bike scheme, where you can buy a bike with your pre-tax salary, which is nice. So there's a couple of different things like that. You can also do it with cars. You can do it with income protection as well. So if you employ yourself, if you're self-employed, it's usually what people say, you can get your company to pay your income protection for you. So it's still a benefit for you, but it's being paid for before you've been taxed, which is a nice. And now getting on to people who are more self-employed, you, as a business owner, you should be claiming every expense you can think of that is legitimate. So paying yourself a salary for a start. There's a couple of different figures. So I think 9,500 is the figure you want to pay yourself if you want to keep up all your national insurance contributions but not start paying income tax. Again, speak to an accountant. And then 12,500 is what you can earn before you start paying income tax. But you can pay yourself a salary, whatever that might be. You can also pay your spouse a salary. You can pay your kids, depending on their tax situation, how old they are. Probably don't try and employ a 1-year-old as, health and safety executive. But run other costs that you have in the business, genuine ones. So travel costs, other running costs of the business premises. So if you work from home, you can put reasonable expenses through, broadband, heating, stuff like that. Stationery that you need. You can get your company to buy your mobile phone, and as long as the contract's in the business name, not yours, the company will pick up the cost for that. Any books or subscriptions, things like that, as long as it's educational, so not Netflix, but potentially, I don't know where the argument would stand here, but something like YouTube, if you use that for work, potentially you could get YouTube Premium and the company could pay for it. And it's something we don't do anymore, but if you have a season ticket, so if you need to be somewhere, you can get a season ticket loan, which is a tax-free loan from the company for you to buy that season ticket. That can save you a decent chunk of money. With childcare, I think it's 25% up to £2,000 a year you can claim back for childcare costs. So that's nice. You can also have a party. So everybody knows, no, not everybody knows. A lot of people know about the Christmas party allowance, which is £150 per head of employees that go. And I think you can take your partner with it and include them. But it doesn't have to be at Christmas. So it can just be at a random time. So you can go spend 150 quid per person and just have a big old knees up, which is nice. And that isn't taxed as a benefit in kind. It just comes off your top line, so you're not going to pay corporation tax on it. So you're saving, 19% at the moment. Another fun thing you can do, which is quite rare, you can pay HMRC your future tax bill early, and then they have to pay you interest, which is nice. They won't be expecting that one from most of you, to be fair. Another big one is pension. So pension contributions, you can pay in £40,000 a year or 100% of your salary, whichever is the lower. And so that is tax-free. There's a couple of different ways with pensions. You can either get it salary sacrificed effectively, so before you get taxed, or you can pay it with post-taxed income, and then the government will top it up, and then you can apply for the difference if you're a higher rate or highest rate taxpayer. So you can do that, but you can also pay into pensions of family members. I think it's 3,600 you can pay in, and they don't have to have a job at all. So that's kind of anybody can pay in that much each year to a pension. So they are very good tax efficient things. It's not really avoiding tax, it's just delaying tax, because you will be taxed that money eventually when it comes out. But the idea is you pay in when you're a high rate taxpayer and you get the benefit when you're a low rate taxpayer in the future. That's kind of the plan. Dividends, I told you this was going to be a long one. Dividends, you can have 2,000 tax-free at the moment, and then it's 7.5% to take you up to basic rate threshold, which is 50,000, and then it's 32.5% over that, and then it goes up to like 38% or something for over 150k, I think. But whatever. And the last, we're on the home stretch now, inheritance tax. So if you're getting old and you're about to kick the bucket, then your inheritance tax is going to be 40% on anything over 325,000, of your estate. Now, there is the additional property nil rate band, which I think is 175. So you've effectively got $500,000 if you're given a property, like your personal property, as part of that, which is good. What you can do, though, to try and avoid and lower some of those taxes is you can give money away. £3,000, I think it is, a year you can give away. There's other different rules for during when someone gets married and between kids and grandkids and all sorts, whatever. Go look it up. The other option, though, is to give big lumps of stuff away, and provided you last 7 years after you've given it away, it's what's known as a potentially exempt transfer. So it does have a tax burden if you die within that 7 years, but if you survive 7 years, then there's no tax to pay. It's just seen as a gift. So there's that way. And then going back full circle now to being good, if you give 10% of your estate away to charity, then you can lower your inheritance tax bill by 4%, which, you know, from a maths point of view, doesn't work out any better for you. But if you were going to give away to charity anyway, may as well top it up to 10% and save a bit of inheritance tax. And then the last one, promise, is slightly more sex and violence end, but things like enterprise investment schemes and venture capital trusts and seed enterprise investment schemes, all kind of the same thing. But they are much more high risk, much more investor focused, but they have the potential for you to save up to £300,000 a year of income tax. We are talking about investing, I think, up to £1 million in some of them. So it is for the higher net worths out there. So if you're at that level, I'm sure you've got your own tax advice, so you don't need to be listening to me. So yeah, that, I think, is a very quick, not that quick, run through of the different ways you can save tax in the UK. Whew.